Hey you guys, welcome back to the channel. If you're new here, my name is Jeff. Today I'm here to tell you, you guys were right. I made a video last week after I had watched the quarterly earnings call with a semiconductor company, and I thought, oh my gosh, this is incredible. Like, I finally understood why something made sense to me as an investor. And I also read Warren Buffett's letter to shareholders the same day, and he said, hey, if you get a great stock idea, don't blab about it to the whole world because their competitive buying pressure is gonna send the price up. Then when you go to buy it, it's gonna be like too expensive. But you guys were very direct with me and clear and just said, hey, we don't need you to like tell us the stock. Just show us your method. We just want to know how do you make your decisions and stuff. So with that said, this is not financial advice. The company that I researched, I am going to go into depth. Right after I make this video, I'm going to go over to my computer and I'm going to do a screencast about this company. There's a whole world out there of data, like financial information, earnings numbers, balance sheet, what are the assets, what are the liabilities, how much did your earnings grow this quarter, all that. But I don't think investing is just about numbers. I think that if it were, then all of the smart mathematician people with their spreadsheets and their projections and their models and their discounted cash flows, they would be the best investors. You just put everything into the software and they'd be brilliant and they'd be insanely rich. But I don't think it's all about quantitative stuff. Otherwise, everyone good at math would be super rich. And as you guys know, if you watch enough YouTube channels, there are a lot of really smart mathematical people with formulas and with spreadsheets and all that, but they're not any better investors than anyone else. Mathematicians are, I admire them a whole lot. Math does not translate to. There are seven basic principles that I use whenever I'm considering a stock. I was considering this big universe and I just narrowed it down from about 25 to about 20, then to about 15, and I just whittled it down, just comparing one company to the next. The first is company size, okay? I want to only invest in companies that are somewhere between about $1 billion and 7 billion or 8 billion. Some of the companies that made it into this portfolio are bigger than 7 or 8 billion, but I don't think I invested in any that were $1 billion or less. In fact, Air Test Systems was one that I almost invested in, but my rule was it's got to be bigger than $1 billion, and Air was a little smaller, and I just thought, stick to your process. $1 billion or more, and this is the sweet spot for me. So you'll find that most of the stocks that made it into my portfolio were somewhere in that range. That is number one. All right. Number two, balance sheet. I look at the balance sheets of these companies, okay? And the balance sheet, in case you haven't studied accounting, and I wouldn't expect everybody here would, but it's just a way of showing the assets that a company has. That is just basically stuff that could be sold and converted into dollars. It's just positive thing. It could be your infrastructure, it could be buildings, it could be your machinery, it could be anything that is valuable that could be sold. And then your liabilities are just debts. So anything that you owe, if you have bills that are due at the end of the month, if you bought a bunch of supplies or equipment, those are your liabilities. So I look at the balance sheet, I'm looking for companies that are growing their assets, and in a perfect situation, they're reducing their liabilities. And those are basically, if you think of your liabilities, that's like your credit card bill, right? And your assets might be how much money you have in the bank, or how many stocks you own, etc., your house. So for a company, you want it to be building up the assets, and if possible, paying down the liabilities or paying down the debts. So that is balance sheet. The number three thing is earnings growth. So I look for companies that are growing their earnings, and there are a lot of companies out there that are actually shrinking their earnings, or they're negative. So they're not operating at a profit. Another word for earnings is profits. So there are a lot of unprofitable companies out there, and A lot of people in the past few years have been investing in unprofitable companies, and then they found out the hard way because those stocks eventually crashed a lot. So I look personally for earnings growth. I would rather invest in a company that shows that it can stay positive and support itself without external money or investors doing additional rounds of financing to kind of keep them afloat. The number 4 thing I look at is the competition. So I want to invest in companies that are either so dominant in their field that it's very hard for others to break in and take their customers. And so if you think of big, well-established companies that have what we often refer to as a moat, I look for companies that have a moat. But in this area of companies that are between 1 billion and say 7 or 8 billion, these are such small companies that most of these companies don't actually possess a big moat. These are not companies that have a durable competitive advantage yet. So what these companies are often doing is they are actually the one using their agility and their technology and their edge to actually take market share from some of the other large players because they are able to be nimble and to get on the phone, get in a meeting, talk to a customer and say, look, we can do this and this and this, and here are the 10 steps we can take that your other vendors can't, that the other supplier of this or that, they're not able to do it because they're big and they're bloated, but we're small, we're nimble, and we can do this for you. So I'm looking for ones who can out-compete, however that is, and when you start reading these quarterly reports or listening to the CEO and the CFO and the COO talking about how business is going this quarter, how it was last quarter, what they anticipate for the next half of the year, you start to realize which companies are really out-competing others in their sector of the market. The number 5, that leads us nicely to talented leadership. And this really, in my view, comes down to the CEO, because if the CEO is good, if they're smart, and a lot of the companies in this portfolio, I'm incredibly impressed by the intelligence of the CEO. So if they're good and they can be trusted, they have talent, they have integrity, then you've got a good jockey riding that horse. And they often, I've found, have nice teams that they've assembled because it's really hard to run a whole company by yourself. But if the people managing the financial side, if the people managing the operations are also really smart and talented, then you've got a good system. So that is number 5. Number 6 is this concept that I learned from Benjamin Graham, intelligent speculation. So Ben Graham, as some of you may know, was Warren Buffett's mentor and his teacher. In fact, Buffett left Nebraska and went to Columbia in New York just to take Benjamin Graham's class on security analysis. And Ben Graham in The Intelligent Investor, a lot of this was about being very careful and thoughtful and spending a lot of time doing your due diligence, making sure that a company was, super profitable and secure before you bought it. But what he said is, it's okay sometimes to make speculation. A speculation is, you know what, I don't have all the information, I don't know everything about this company, but I want to make a little bit of a bet that this is going to work out. So he said the way that you do that is that you do many of these speculations, because if you just put it all on one, then that company fails, then you're out of luck. But if you make multiple speculations, let's just say like 10, and 1 or 2 or 3 of them don't work out, that's okay because they're often offset by the others that do very well. So I've just kept this in my mind because my tendency is to be very careful and not invest until I know everything about a company and I'm very secure and I'm very sure about it. But if you do that, a lot of times it slows you down. It slows me down because I'm so hesitant and careful that I don't make those high velocity decisions where, like for this portfolio, I needed to buy 10 stocks and I needed to do them on the first trading day of 2024. So I had to be decisive. If I waited until I knew everything about all of these companies, I still would not have bought them all, or I would have bought just a couple of them or whatever. So somehow you have to have a mindset. And my mindset is, I'm going to be speculating to some extent, but let's do it intelligently. Let's do it by having a portfolio of slightly risky bets. But taken in aggregate all together, they reduce the volatility of any one of those companies having a problem or failing or having the price go down. So that is the intelligent speculation piece. And number 7 is simplify. I can't tell you how useful it is to just keep things simple. All of these stocks that made it into this portfolio of 10 started as watch lists that I had on my phone, in Robinhood, in my stock tracker app, and I would just build this. As I came up with an idea, as I watched a YouTube video, or as I learned about a semiconductor company, I would add it to that watch list. And the watch list just grew. And then, I had like 25 companies. And what I did gradually is, as I learned more, I would just realize that which one can I discard? Which one do I not know enough about? Which one is not yet profitable? Which one of these companies has a lot of liabilities? And I would just, trash the ones that I didn't like, just delete them from the watch list. And then I eventually, on those last days of December, before this year started, I just deleted it down to 10. And the 10 survivors are the ones that I went with. So anyways, those are my 7 steps. I wanted to just share them with you here in this video. And I'm going to now go and record my screencast where I actually show you the screen stuff that I look at the computer that helps me to decide on the things like the balance sheet, like the earnings, and then you'll have an idea kind of firsthand what I look at when I go about make these decisions. So if you're new to the channel, you haven't yet subscribed, subscribe now, because this other video is going to drop probably, a half hour after this one. And, I don't know, I have to put it together and edit it and stuff, but it's going to be live very soon. So if you want to see my method on the computer, then hit subscribe and you'll get the notification as soon as it drops. Thank you guys so much for watching, and I will see you in the next video.